Introducing the most consistent option strategy, the wheel. The wheel is built on two of the most profitable and beloved options, selling cover call and selling cash secure put. Let's go through the steps one by one, followed by live examples and some of my previous experience and how it played out. Let's dive in. When buying a call, you have the right to buy 100 shares of the stock at the strike price. When selling a call, you have the obligation to sell 100 shares of the stock at the strike price by the expiration date. When you buy a put, you have the right to sell 100 shares of a stock at the strike price. And finally, when you sell a put, you have an obligation to buy 100 shares of the stock at the strike price by the expiration date, assuming you get assigned. So in this strategy, we are going to use two of them. We are going to use sell a call to collect premium and selling a put also to collect premium. Let's go through the steps and slowly it will fit into place. If we want to Google and do a quick search about the wheel strategy, you will get this picture. This picture is a simplified version of the wheel strategy. It's basically start by you selling a put on a certain stock for a specific strike price and collect premium. As you can see, it's highlighted in green here. If assigned, then you sell a call on these stocks that you have purchased and collect premium again. Now, if assigned, the stock get called away and you collect the profit and then you just restart it. That's a simplified version of the wheel strategy, but I'm going to add additional steps in between just to explain it further and dig deeper how you can optimize it and collect more of a premium and collect a bigger total return. Remember, the idea or the goal of the wheel strategy is to collect premium while avoiding assignment. Okay, so let's go through the expanded steps of the wheel strategy that I have. Step 1, selling cash secure put out of the money anywhere between 1 to 3 months, and you want to get a delta around 0.3. It could be higher or lower depending on how you are bullish or bearish on the stock and what do you expect the price movement during the upcoming period. Now, I have the addition of step 2 here. As you can see, step 2 is an assessment that you have to do to the option once it gets close to the expiration date, which is, do you want to roll over or do you want to get assigned? Basically, you want to see if which one will give you the better return in this scenario based on the IV, based on the price of the stock and how much you can generate return on it. And I will go to more details when we get to the live examples. Step 3, after, let's assume you roll it over once or twice, you are eventually going to get assigned or it's going to get expired out of the money and you go back to step 1. So assuming you get assigned, you're going to start with step 4 after that, which is selling a cover call on the stocks that you just purchased during the assignment in step 3. And you want to sell a cover call above your cost. In certain scenarios, if the stock crash hard, you might want to sell a cover call above your adjusted cost. And when I say adjusted cost, I mean including all the premium that you collected in the puts. But I don't recommend that unless in extreme cases, because if you sell a cover call for less than what you purchased the price in the step 3 when you got assigned, you are risking, if the stock bounce up, you are going to risk losing all the premium that you have collected over the past several months when you were selling cash secure put and rolling it over. So you don't really want to do that unless it's an extreme case. In most scenarios, I will advise you either selling the cover call at the same price where you get assigned, or even at a higher price if you were like close to the money or the premium from the implied volatility was high. Step 5 here is similar to step 2, which is basically when you get close to the expiration date of the cover call, you are going to evaluate whether you want to roll over your cover call and keep the stocks in your account, or you want to get assigned and just start the process all over. Eventually, after rolling over once or twice, in step 6 will come when you get assigned and you are going to sell the stocks that you bought in step 3. And in this case, you will finish the wheel strategy and you will just have to start it over by selling a cash secure put. It could be on the same shares or it could be on a different shares if your view on that company have changed by any chance. So remember, one of the benefits of using the wheel strategy here, as you can see, if the stock price have stayed the same for a year, 2 years, or even 3, you are probably not going to collect any profit from that shares unless it's pay you some dividends. By using the wheel strategy, you will be able to print money while waiting for the stocks to make a move. So if it took 2 years, 3 years, you will be able to make a lot of money during this time. An example of that, if you saw my video about selling cover call on Apple, you will realize that I have been collecting a lot of premium while waiting for Apple. And Apple price have been around the same range for like what, 2 years, 3 years. You can see in December 2021, it went up to the 179 and it kept in this range for all this time. And even now it's only at 191. And just a few days ago was 165. So as you can see, 3 years, it didn't make a big movement while I was keep collecting premium from my cover call. If you want more details about that, please click the video in the description. Let's go ahead and take a few live examples and hopefully slowly the picture will be clearer and clearer. So let's go and jump to trade Tesla options. We're going to change this to put. And we want to sell a put, which is also known as cash secure put. We're going to go for July 19. Now I'm choosing July 19 date because this is the monthly expiration date. So in this case, it's about 39 days. Let's go ahead and look at the deltas. We are probably interested in a delta close to 30. So as you can see, there is no specific 30 here. There is 33 and there is 27. In this case, I'm going to go and take the 27. It's a little bit safer than the 33. Basically, the delta give you the percentage of how much the stock might end up in the money. As you can see here, there's a 33% chance of you ending up in the money, meaning getting assigned. While in the 160, you have a 27% chance ending up in the money. Obviously, because this is safer, as you can see, you will receive less credit than what you would have done if you sold the 165. I think overall, choosing something that doesn't get activated will give you the maximum win for you, because in the case you get 165 and you receive the $7.38 per share, if the stock end up being 162, 163, that will basically eat up most of the a credit in order for you to buy to close and then sell to open a newer one, meaning rolling over to a further date. However, when you go for 160 and it ends for 162, 163, you will expire out of the money and you will get to keep the entire premium. So really, in the long term, if you stick to a lower delta, although you are collecting lower premium, you are going to end up with more money in your pocket. So here, if we want to sell the 5.63, the 160 for 39 days, let's see how much percentage does that make us. That will result in 3.5 in just 39 days, like 1 month, 0.3. That's really great. If you can repeat that process, that's going to give you a great return per year. So roughly that will end up being 32% per year. If you know compound interest, that will be amazing. It's just getting 10, 12% will be great for the long term. Imagine what you can do with 32%. In reality, you're probably going to get something similar. It might be a little bit more or a little bit less. It depends on how lucky you get with the stock. Now, let me give you an example how a rollover will work in case the option went against you and the price dropped down and you wanted to roll over instead of letting it assign. In this case, let's assume we have an obligation to buy the stock for 180. Okay, so as you can see, the 180 is in the money right now. In the put is the opposite of the call, as you know. So being above the price, meaning it's in the money. So in this case, you will buy to close for 8.4. So assuming you have the 180 as an obligation and you don't want to buy the stocks for 180. In this case, you will buy to close and then you will go ahead and go and try to roll it over into a further date while collecting credit. So let's start with July 19. If we went to roll it over for 1 month or a little bit above a month, and we come here, we can sell for the same price. If we are expecting the stock to bounce back, there's nothing wrong with going with the same strike, collecting, as you can see, 6.38 credit per share, meaning $638 for having the same responsibility. We are still going to end up buying the stock in case the stock drop for 180. Just we are buying it a month later instead of now, and we're collecting another 638. That is just great. Now, in case you are expecting the stock to keep dropping down, you have an option to sell for a lower strike price. So in this case, look, if we said we're gonna sell the 175 in a month, you are removing the obligation to buy the stock for 180 while starting a new cash secure put to buy it for 175, meaning you reduce it by $5 per share. You just saved yourself $500. And on top of that, you are receiving $353 per contract. That is the power of the rolling over when the stock has a good IV, like Tesla. Let me give you one last example. If you are really afraid or something fundamental change about the stock and you don't trust that it will bounce back or stay the same, you can even go out of the money. In this case, we are rolling over for 1 month and we're rolling for the 170. As you can see, we are still receiving credit of $100, $108, really, while reducing our obligation from buying the stock for 180 to buying the stock for 170. That is just amazing. You are saving yourself, you are still collecting credit without actually owning the stock. And if the stock just stayed the same at 174 or just bounce up a little bit, you get to keep the premium, you get to remove the obligation or release the collateral and just repeat the process again. Now, one last thing, I want you to consider your option. You always have the option between rolling over versus letting it assign and then owning the stock and selling a cover call on it, which will be the next stage in the real strategy. So in this case, let's go back to June 14. We are going to remove this. Let's assume the 180 gonna get activate on us and we are going to buy the shares for 180. In that case, we are going to go for a month and press on the call, and we are going to sell the cover call for the 180. As you can see, you are going to receive 9.7 credit for offering to sell the price for 180. It's really great. As you can see, you can collect 970 per contract for selling a cover call for the price of 180. It's the same price that we are purchasing the stock for. So in this case, we are not making a profit on the purchase and sell of the stock, but we are collecting the sweet, juicy premium from the puts that we sold in the cash secure put, and then from the premium that we collected from the cover call. Of course, you have the flexibility. If you are bullish on the stock, you can go ahead and sell the 185. You are going to collect a little bit lower premium, but in return, instead of selling the stock for 180, you are going to sell it for 185 in case it bounces up. And the opposite also apply. In case you were bearish on the stock and you think something changed, you can sell the 175 and collect more premium. However, you are running a small risk. In this case, if the stock bounces back, and instead of selling for 180, you are selling for 175. So the difference between this, the $5 per share or the 500 per contract, is going to eat most of the profit here. Because here you are receiving 11.85, where $5 or 500 gonna go just to make up the difference between buying it for 180 and selling for 175. So I want you to keep that in mind when you deciding which call you wanted to sell. I would recommend in these scenarios, since the difference in premium is not really huge, I will go ahead and sell at least for the same price that I purchased for and collect that sweet premium, the 9.7. In that case, if it get activate on us and we get assigned and we get to sell the share for 180, we get to keep the premium from selling the cash secure put for 180 and selling the cover call for 180. So we are getting paid 2 times. Now, one last thing to consider in this scenario, when you're trying to decide between rolling over the cash secure put versus getting assigned and then selling a cover call, take into consideration if you are using margin. For example, in a lot of cases, you will find me, I'm using my margin for selling the cash secure put. So in that case, I am only getting the margin hold as collateral for free. I don't pay interest on that. However, if I get assigned, I will have to purchase the stock with the margin and I will have to pay interest on it. Robinhood used to charge a margin 8% per year. But as you might have seen in my videos, how Robin won me again, the margin have dropped from 8% to 6.55, which is great. But remember, I am still going to pay the interest on the Tesla share in case I bought it for 180. So you have to take that into consideration. So assuming I hold 100 share of Tesla at the price of 180, I will be paying interest for the amount of 127.72 for the 39 days. So I will have to take that from the premium that I'm receiving to identify what's the true value for me. I wanted to show you one more benefit of rolling over the cash secure put versus getting assigned and then collect that premium. As you can see, the premium, as you can see, if we get assigned and sold the cover call on Tesla, we will collect about $900 per contract, which is much higher than collecting 3.53. However, remember, in this case, we are lowering our obligation from buying for 180 to 175. This will help us significantly in case Tesla share kept dropping down. Meaning, if the Tesla shares at the end, at the July 19 become 160, it's probably not going to pay as much premium to sell the cover call for 180 again. However, in this case, because we lower our obligation from 180 to 175, we will be able to successfully roll it over and collect credit again instead of paying debit or be forced to get assigned. So you're going to have to measure the advantages versus the disadvantage for your specific share and your specific scenario before deciding if you want to go ahead and get assigned and sell a cover call or just keep rolling the cash secure put. Now we're going to the second stage. After you sold the cover call for the stock that you just owned, in case the price went above your strike price, you will have the option to either roll it over again for a credit, but this time you buying to close the old cover call and then you sell to open a new cover call further in date. And you will compare the price between if you roll it over, how much credit you're going to get versus if you have let it get assigned, you get back all the price you paid and then you sell a new cash secure put. Let's assume we have a 170 cover call and right now it's 174, so it's in the money. If we don't want to sell the Tesla shares for this price, we can always buy to close and then sell to open a newer one. Also, we're going to go to July 19 since it's just a little bit above a month. And we can sell either the 170 and collect 738, or if we are bullish on the stock, we can sell the 175. We are going to collect lower premium in this case, 485. However, we are selling it now for 175 instead of 170. Either we get to sell it for a higher price or it get to expire out of the money. And then in that case, we get to sell a new cover call and collect the full premium. Knowing when to roll over versus when to get assigned will depends really on the stock, the premium, and how much do you feel like carrying the shares. So I just mentioned that having a margin account and using your margin will cost you interest for owning the shares. I can also give you the opposite when you are not using margin or you don't have a problem with paying the interest on the shares. You might also collect dividends from that stock. So in the case of Tesla doesn't pay dividends. But if you were to do this strategy on Ford, on GM, on Apple, Microsoft, any of the companies that pay dividends, the dividends will offset the interest you are paying on the margin and will increase your profit in case you're not even using a margin. So let's go ahead and discuss an example I have on Alphabet, Google. As you can see, on June 18, I sold the cover call for just one day for 143, and I have collected $75 per contract, resulting in $300 credit. And on June 19, I decided to let two of them get assigned and sold while the other two contracts, which is 200 share, get rolled over. So what I did here, I bought to close the Google 143 January 19 for 206. And at the same time, I sold the 145. So I went up $2 and I went out 1 month. So it was for February 16 and I sold this for 516, resulting in 310 credit per contract. And since it's two contract, resulting in 620. Move forward on February 20. Move forward in time, Google stocks dropped to 139 if I remember correctly, so it's expired out of the money. So I went ahead and I sold for 4 months, this time expiring in June 21, and I sold the same strike, 145. And as you can see, because it's expired out of the money, I was able to sell and keep the entire premium. So I have sold it for 745 per contract. So that's mean it was 1,490 for the two contract. That is just beautiful money, you know. This contract, if the 145 June 21st, this is still open for me. If I go back to my account, you can see it here. You can see the stock collateral. Of course, as you might already know, Google stock have run up significantly. This is when the February 16 expire. As you can see here, it just shows the average. It was 140.52. But if I remember correctly from memory, it was around 139. In any case, it dropped to 131, but since I sold the cover call for 4 months, I really didn't care, and I collect very juicy premium, the 700 and something per contract. So after that, it started running up. Right now is 175, meaning it's very deep in the money. Let's go ahead and open this contract. As you can see, today was a positive day, minus 4,576. And this is the premium that I collected previously, 745 per contract. In reality, I'm not really losing. I'm just missing on a potential profit. But since it was already I'm playing the wheel strategy on it, this is not a long-term investment for me. I don't really mind. As you can see here, even if we went ahead and went a year, and the future is not going to be very beneficial to roll it over. If we just want to roll it over from 145 to 155, I'm going to have to pay a cost of $8 per contract. And that's just potential winning $10 for the entire year, or it's like, to be exact, it's 221 days. It's not very good. So in this case, I will just let it get assigned and sell new puts. If I want to go ahead and sell a put for 150, I can collect 430. And this is for Delta 18, is way too low. So if we want and take a look at the other deltas, again, if we want closer to the 30 delta, in this case, we're going to sell the 165. We're going to collect 838. It's so much better than keeping the stock with me and rolling it over for $5 or $10. Remember, if I kept the stock until the end of the year, because I'm using margin, I will be paying around $1,166 for interest for the 200 share. That means it's going to eat most of the profit that I'm doing from rolling from 145 to 155. So going ahead and let it assign and then sell it something like the 165, it will be so much more beneficial. Or I might just go ahead and sell a cash secure put and start the wheel strategy on a different stock with the same fund. I probably will choose a stock that has a little bit higher of IV that can generate a better return for me. Another example of rolling over the cash secure put can be found in my Tesla video, but to give you a quick summary, as you can see here, I have an obligation to buy the share for 190 on March 15. And I just didn't want to use the margin to purchase the stock because that means I have to pay interest on it. So I went ahead and I roll it over for 3 baht and I lower the obligation from 190 to 180 while collecting a premium of $145 per contract. And it just worked out great for me. Right now, Tesla is 174, but it keep going up to 180 and then dropping down. So really, the wheel strategy combined two of the most beloved options is the cover call and the cash secure put. And if you know how to roll over correctly, you can really avoid getting assigned and add more protection to your trade while collecting these constant premium, generating more income from either the collateral that you are just getting whole for the cash secure put or from the shares by selling the cover call. Remember, you can always roll up a cover call or roll down a cash secure put depending on the direction of the stock to give you more protection and more premium. Please let me know if you have any questions or you want to see more examples and more videos similar to this. I can definitely add more details and add other examples that I have. If you like this video, please hit the like button and hit the subscribe, and see you guys in the next video. As always, the information provided in this video is for educational purpose only. Investing involves risk, including the potential loss of the principal.